Okay, so welcome to the second reboot session. This is being recorded for later reviewing. So last time when we met, we talked about market tops, and so we went through these different various topics, and we did finish the section off. But let's just, by way of recap, take a look at market tops, and I have a chart here of 3 market tops. So we'll take a look at each one of them. This is the 73 top. So basically, in terms of looking at market tops, this is actually a weekly chart. And normally you would be looking at the daily, but because of this, how far this is going back, it's we'll use the weekly. So it's a good approximation for reviewing. So typically, what will happen is that to detect a market top, you're looking at upward stalling, distribution days count starting to mount up. And though the counts have gone up over the years, so now it's more like 6 to 7 over a 20-25 day period. It used to be 5 to 6, and then before that it used to be 4 to 5. So that has been gradually inching up over the years. So if we take let's take a look at the 73 popular. So we can see how this one basically moves up. So let's just go back in time here. Just get the mouse. So as we go through 70, 71, 72, so we can see the market in an uptrend, and we've got reasonable corrections coming back in, but still mounts an upward move. So there's some strong correction here, kind of makes a little double bottom and then takes off again. But you got strong accumulation coming in here. So the market, although it probably gave a nice tradable correction and a follow-through day, worked here for this last leg up. So if we continue, the market finally tops in 73, beginning of 73. And this is one of the signs that you're looking for. So here you can see big downside reversal, stalling day, and big downside reversal, stalling day. And typically, you take this one because, and again, that would be on the daily chart. We're looking at the weekly, so this is not directly applicable. But we got a few up moves here. Doesn't make too much price momentum up to the upside. We do have new price discovery, but it can't find higher ground, and it's knocked back down. Then we've got this kind of not quite a perfect railroad tracks pattern here, but you can see the closes are pretty much exactly the same. And the lows of the bar close, but although this one went higher. So that kind of gave another little clue. The third clue is, and again, this is weekly. So as the market starts to come down, you can see the volume actually starts to taper off. So that is another little subtle signal. And one other point to bear in mind is that as the market comes down, you can see the volatility is picked up. So the next thing we're looking for on the way down is 3 legs down, because that's typical of a bear market. I mean, it's not always perfect, but so we're looking for low points where we can call a leg down. So here's potentially one. There's potentially one here. So let's just have a look, go a bit further. So, yep. So there's still bottoming action here. It's one leg down. Tries an attempt, but doesn't get anywhere near to the prior highs. Sells off in big action. So that really kind of confirms that we have weakness. Here's a second attempt. Tries to stabilize. Can't muster any strength there. Then if you look at the volume, it's pretty low. So there's no volume supporting this move. That's another trait of rallies in bear markets. And then it finally makes the last leg down, which is usually the longest leg. So it's kind of interesting that the last leg down becomes the steepest. So it's almost like the market up here falls slowly, and that's probably because you've got the buy the dip people coming in, and people are still in a bullish mentality. And so as the market comes down, people are buying in, and until they get caught, and then you start get the shorts start to move in. You get a short covering rally here, and then finally the shorts give up, and the people that bought up here buying these dips start to give it up, and then as we get this big crescendo to the downside, a couple of things happen. Short selling starts to change, and people start to sell out of their positions because they can't take the pain anymore. Once that starts to happen, the market will try and find a bottom. And in this case, we get a nice upside reversal weak, followed by a larger one. And then it comes back down and importantly makes a higher low here, then the low down here, which tells us now that potentially we have a trend change. And by taking out this peak over here, then you've got confirmation that we're now into a new bull. So the 73 market is actually a good one to study. A lot of good points in that one. So if we go forward, and then let's take a quick look at the 2001. In fact, let me move that a little faster. So if I can just grab this. Okay, so here we come into the 2000 through the 19. Again, there was a short little correction over here. On a weekly, got a little double bottom pattern. That follow through day here would have failed. This one would have succeeded. Again, bear in mind this is the weekly. Okay, so here comes the 2000 top. Market moves up, and then here you can see this is a topping pattern right here. So it's worth studying this. You get tops aren't like bottoms. You can have tops take time to distribute. So distribution starts over here, and you can see people are selling there, whereas you've got multiple weeks of selling showing up in here, and some big spikes to the downside as well. And then finally, here we can see at this rally here, we don't take out the prior peak up here. And if you look at the volume associated with these down bars, you can now see a pickup in volume. So we've got a lot of distribution, and tops typically are like a mushroom. They're the silhouette of a mushroom pattern. So then we break, and let's have a look at the legs and stuff. So we're looking for kind of three areas where the market comes down. So here's potentially 1, 2, and 3. So those mark our 3 legs down. We get a strong reversal, and this is typical of a bottom at the end of a bear market. You would usually get a deep tail on the candle, and it finishes strong. So which is telling us that on very high volume that there's a lot of buying starting to come in. Starts to move up, and it doesn't come down. But this one fails. So maybe we were premature in our count here. So maybe that was the first count, second count, and then we got a potential third one down here. So that would have been a fake out. But here we got a double bottom in the true technical sense. So it tests support and slight undercuts here. But as it rallies off after this undercut, now we can see that the low here has been held. And as it takes out this prior high, swing high here in this region, and that confirms that we should be in an uptrend. So that one was a long one. So there we go. Market's off to the races. And we can see typically in a new bull is when it's good going to make money in the markets. So let's go a few more years. Let's take a look at the 0708 top. So this one again, so you've kind of got a classic head and shoulders type of pattern here. So we've got, and this is a kind of a more of a the classic pattern is the market's going up, and this is the first test, and so they're testing. The sellers are testing to see if there's still buyers out there, and then there are. So it moves up. They move up a little bit more, and then they test again. They sell off big time. So people are still in the mentality of buy this dip. They'll buy this dip because this looks like a strong week up. And then, but as you can see in this rally here, right, there's no volume. So although we're moving up, the volume's coming down. The volume's gone down. But on the downside here, we can see volumes picked up. So there is a lot of distribution coming to the market. And so market's down in a downtrend. And we can see again that makes move down. So this is fairly close to each other. Maybe could be arguing that that's one leg down. That's this leg's a bit short, and then the last leg down looks pretty strong. So it's kind of one. This is all kind of clumped in. So maybe you could go down to this one, or this one. You go, and then you get this longer leg down here. One more rally here, another leg down here, and then you can see a big upsurge in this bar here. It takes out this swing high here, and the market's off. And although, like with the IBD model, you would have been in a lot earlier, rebound Marchish around here because you're looking for the follow-through days. But using the 3 legs down is handy because it kind of helps you navigate where you're at. And when we discuss rules, you'll see why. Okay, so that's kind of it. After the market tops, so those are the kind of things you want to look for. You really want to start studying the rallies in the downslide, and then you want to also start looking at how many attempts it takes, how many bear counter rallies it makes, what leg you are in terms of the downside move. Expect 3. It's not always 3. It can be less, and sometimes they're hard to read because they're not always picture perfect like in the books. So that's where chart analysis and historical precedent analysis comes in. So the rally attempts may fail. So there are other. I showed you 3 bear markets, and these are 3 of the bigger ones. But there's a whole bunch you can study. You can study the 94 correction in September. There's also one in February. You can study the 97 October 97 correction. There was the obviously 87. We had a crash in October, but that was just that was a true crash. There was like no evidence of a topping process there. Other ones, January 84, September 76. So it's worthwhile going back and taking a look at these if you have access to a charting tool that will go back that far. Okay, so moving on, let's take a look at so in our discussion. So we talked a little bit about the rally attempts. We talked a little bit about the bear leg, having bears with 3 legs down. Vertical violation, I will skip that. So this was an additional item to where they had, where you got a severe break from the top when it kind of drops 3% quickly. So I'll cover that another day specifically because that was added much later. Other things we can look at is index divergence and convergence. So if in the rally attempts, if one index moves up, but it's not confirmed by the other indexes, that's usually an indicator that that it's a weak rally and that the up trend will fail. So that's just another indicator for that. Short selling peaks near market lows. So as the market starts to pump down, that's why in that 3rd leg down is usually drops further than the first 2, is because that's where a lot of the short selling starts to happen, because people were trend following we'll start to take a look at that and decide, okay, now's a good time for me to short because there's a trend in place. And so when that picks up, it usually means we're close to a change. Then another secondary indicator is the advanced decline line. So this is the advanced decline line, which is actually on the NYSE that we want to look at. And again, if the market is trying to rally and it's not confirmed by the AD line, that is an indication that it's a feeble rally, may fail. Bear in mind that this is a secondary indicator and is lagging. It will also, but one thing it will show you that if the bulk of the stocks aren't ready to move up and only a few stocks moving up, it's not going to be enough to move the AD line. And then another indicator we can look at, indication on the chart we can look at, is the undercut of prior lows. So I showed you one of those in one of the three charts that we just looked at. Okay, so all of this then should help you to continue to study market bottoms and the rally to the downside, but it's leading you to a point where you need to be thinking about and looking for a point of entry. So a couple of things will help you there. One is, which leg are you in on the downside? Has there been, and do you have at least some levels of confirmation in terms of the secondary indicators? And then be on the lookout for, now you're looking out for rally days and potential follow-through days, and start to watch those along with stocks, especially new merchandise that's come to the market recently, setting up, and some of them even starting to break out, even while we're in this downtrend, right? Because some of the best finds are going to be, will start breaking out several weeks before we actually get the follow-through day. And the reason that you want to be doing this is because, and here's the big nugget. It's in, and Bill O'Neill writes this in his book, and to quote him, the real big money is usually made in the first 1 or 2 years of a normal bull market cycle. It is at this point you must recognize and fully capitalize upon the golden opportunities presented. So and there you have it, right? So that's your window with canceling a new bull market with normal action that emerges. So you get your follow-through days. You're looking for good stocks that are either just breaking out, or in solid basis and at that stage they'll probably be making bottoming bases that are ready to move and have the hallmarks of the fundamentals that we want to select from, because it's that run in that first couple of years where you can easily get doubles and triples in your portfolio. So that's why you really want to study these down moves, and so you can be ready. And then what happens is once you're into the first or second year of the new bull market, you'll have Bill says that there'll be a couple of intermediate term declines in the market averages. So here we're talking about 8 to 12% typically, and occasionally it could be as low as 15%. And we saw a couple of those in the charts where after it started to run, there was a correction, not too dissimilar. So those are the opportunities where Bill writes that you need to be able to hold your stock through the first or second corrections, right? So it's not so you don't be holding through corrections late or mid cycle. It's after when you're in the first couple of years of a new bull, because the market will correct, your holdings will correct, and if you are able to hold on to them, that's how you hold on to a stock to get big winners. So in the first couple of years, you want to see if you can hold your stocks for more than the 20% gain that most of the strategy looks to get. So that kind of covers markets. There are a couple of other things you can look at, and so the one of them which I find particularly useful And this is for really economic cycles. It's the M2, because the M2 is a good long-term indicator of how the economy is running, and when that starts to turn back up is an indication. But again, it's these lag indicators, right? And they have long moving averages behind them. And another one that you can start to see is the NASDAQ volume as percentage of the NYSE volume starts to tick up after being in the doldrums for a while. Other things, depending on what's happening in the larger economy, there's the Fed funds rates that you can draw upon, and you can look up those. And now, obviously, we happen to be at a point where we are about, and actually the FOMC meets next week, so we're about at a point where the expectation is that the Feds will cut half a point in September. Some people think it may be even a full half point, or it could be a quarter point. So we'll see what happens. And typically, historically, when the Feds have started to cut after a rate hiking cycle, that has usually triggered recessions. So these things are not guaranteed. They're indications, and you can study them historically, but it doesn't mean that just because it happened the last 3 or 4 or 5 times, it'll happen the 6th time or the 7th time. So it's always best to follow price and volume. And in the IBD system, one of the really good things that they have in there, and they're not as emphasizing as much these days, is look for that follow-through day action and be ready to come back into the market. And the key thing is, as you get into that third leg down, that's where you really need to amp up your homework. You need to be looking for the merchandise. You need to be looking for a basis setting up, and they won't have prior uptrends because of the down market. So there's some things you need to let go, but look for quality basis, look for signs of accumulation, look for early breakouts, and even start buying probing test positions even while we're in that third leg down, just to get an early start and start building your positions. So when you do get the bottom and you get the follow through day, you are in position. And then at that stage, as opportunities come, then you can increase your holdings. You can then add to your positions along the way. You're able to hold through the first or second correction of your holdings, as long as they're the sound and resilient. And that's how you get to those 100%, 200%, 300% gainers within the canceling system. And that will obviously can change your portfolio significantly. Okay, so that's markets, and I will come back periodically and we'll look at some more finer points of markets, and maybe even look at some other topping actions. And right now, the market, it looks like on the daily S&P, the market's looking a little bit like the 2007 S&P market. So you may want to study the current market and go back and look at the 2007 markets. All right, so I think that's the content I wanted to cover, and so we will leave it here, and so we will meet next month, same time. Good night.